and I'll be doing that fast. So let me quickly share the screen. Let me share screen. Okay. All right. Can you all see my screen?
Yeah.
Okay.
See your screen.
Yeah, we can see.
All right. So I would quickly, since this is where we were previously before we had some difficulties, and I'll quickly run over this. If you look at the next month, which is March, you see that this particular person actually had a sales of 7,400, better than February and better than January. And then his direct material cost, he increased his products. He increased his sales. He increased his sales by 500, which is the nice thing to do. So if you are seeing more sales, please increase the production. Okay, that is gradual increment. Do not increase at once. As you see sales coming in, so also your increment of production. So you keep increasing your products as you see sales, and you see that he made zero zero profit, zero gross profit. If you saw that, that's a very nice thing, dear friends. He has broken even. He made zero. So no loss, no profit. And this is beautiful. I mean, it is a very green light at this point. So if you have gotten to this point in your business, kudos to you. All right. This is how you should forecast your sales and cost plan. It's giving you a very clear picture of what you should do, dear friends. Now, if you look at the indirect cost, he still has indirect costs, because of course you cannot do without having indirect costs, dear friends. And his indirect cost is still 2,300. So he is now having 2,300 as a loss. Okay, still a loss, as against 4,800, okay, of the previous month. Now, if you look at April, there's a forecast of 10,800 naira, which is made as sales. Beautiful. He has direct material costs. He increases because he has made more sales. He decided to buy more items, and he made a direct material cost of 8,700. Very good. And the labor cost remained the same. Direct labor cost remained the same, and he had a profit of 1,200. A very nice forecast there. This is a very nice outcome, and I want us to learn from this. There is still a loss at the end of this month. It's still a loss, but the loss is much more reduced compared to the previous months. And this is the fourth month, dear friends. He has not made a profit for himself. He's putting in money. He has made a profit, but he's making sales. So if you see yourself putting in more money and you have not yet made profit, you will not know that you are making profits, that you are making a good business. You will not know if you don't have a good sales and cost plan. You will think you are running at a loss because you keep putting in more money. Look at the money he put in to start up to make the first production, 2,000 naira. Look at the money he put in to make the second production, second month, 6,000 naira, 6,500 for the third month, 8,700 for it. So he's putting in more money, okay? But you can see that he's making more sales, okay? So he's putting in more money, but he's making more sales. Now, let us go to the fifth month, May. In May, he made a sales of 13,500, And this time, he still made the same direct material cost. So at the same direct material cost of April, he has a sales of 13,500. Very good. His labor remained the same. Labor cost is still the same. This time, he makes a profit of a gross profit of 3,900, and he has the same indirect cost, and he has a profit. I believe we should be clapping for this man right now. He has broken even completely. Look at the amount of months it took. Look at the amount of months it took, dear friends. Many of us here would have started agitating. Once we not make profit in the first month or second month, third month, fourth month, but by this time we will start feeling bad. No, if you are studying your business, if you are monitoring your business, and that is what sales and cost plan helps you to do. It helps you Hello?
Hello, can you hear me? Can you hear me?
All right, I lost.
My screen is not showing again.
Yes.
My screen is not showing again.
I lost connection. I'm sharing it back again, please. I lost connection, so you can see it right.
Okay, thank you.
Sorry, it's Nigerian factor. That's Nigerian factor, connection, network, and the rest of them. That's why the fact that I'm using a 4G light. Anyway, so all right, so moving on from here, please take note of the next month, which is June. So June and May has the same net profits, the same gross profits, the same direct material cost, and also the same sales. So do not be overly optimistic, please. Investors would see through your business plan, your financial plan. If you are overly optimistic, don't be overly optimistic. Be a little bit pessimistic, okay? But make sure that the aim of your business is to make profits, not to run out of business, but you are not making profit in the first few months, okay? Make sure you don't run out of cash. So your business plan, the cost plan and the sales plan will show that you are not running out of cash, okay? Because at the point when you see that you are running at loss more than the sales coming in, then there's danger. There's red light there. If your cash outflow is more than the cash inflow for several months, then there is danger. So, but you can see that there's improvement in the 5th month. All right, so let's move on. This is sales cost plan, and I have done this so that you would appreciate the difference between the production. For those that are going to production, you will see the difference. This is production, okay? So this is production, and just after it, you have sales. So this person is on sales, he's dealing with sales. Now, once you are dealing with sales, your sales and cost plan may be a little bit different. I'm having network instability again, unstable network. All right. So I don't know how long I'll be cut out again. All right, so please look at the screen and you will see that just take a quick look at the direct material costs. Direct material costs for the first month cost 15,000 naira, while the sales was just 1,500. If you look at direct labor costs down from January to June, you will see that everything there is zero. That is because you don't need labor when you are dealing with sales. You may be the only person running the business at that time. And since you're not dealing with production, okay. Sorry, people are still joining in. Okay. Sorry, Dr. Mide is just joining in. He has not been in with us. All right. So I believe we are good to go. Yeah, David. Okay, David has joined now. All right. So let me minimize this. All right. So now this is your sales. For those that are going to be dealing with sales, okay, we don't know your business right now, but if you're dealing with sales, you don't need direct labor costs, because direct labor cost is involved. You're not the one producing the things you are selling. And remember that direct labor cost is involved in direct production. So all those involved in production of the goods are placed under direct labor costs. Now you are not producing the things you are selling. Hence, there is no cost for direct labor. And if you have a sales girl, or a sales boy, please put that under indirect costs. Do not put it under direct labor costs. It does not work that way if you are running a sales business. Now, you would see that there is still indirect. You will see that there is still indirect cost there, and the indirect cost is about 6,000 naira here. And the indirect cost may involve your sales girl, the amount of money you are paying your sales girl, the amount of money you incurred bringing the goods down from the market to your store, the amount of money involved in powering your generator or paying for the cost of power supply, as the case may be. And this person did not make sales right from, if you look at it, from January to June, he still had loss. But there is a bit improvement at the last 2 months. So if you notice that the last 2 months, he made a sales of 14,500, and that was consistent for May and June. All right. And his gross profit was in the negative, but reduced. It was 500, an improvement from the previous ones. Okay. So you can see that okay. So please, I will advise that we mute, please. Everybody should mute, please. All right. So this is not also bad. It's not also bad. If you are making sales, the sales have increased from January to June dramatically, and the direct material cost went from 15,000 to 2,300 to 7,500. He increased the direct material cost when he saw that he was making more sales. And that is why you see that there was no major gross profits, no profit. However, an investor will see through and see that this person has prospects because he increased his direct material cost, seeing that he was making more sales. All right. So this is also very, very okay. Very, very okay. And if you have the benefit of going to the 7th month or 8th month, would record profits at the end of this at the end of the 7th month or 8th month if we forecast for such a duration. All right, so let's move on. All right, so let's move on. Now we are in cash flow, a very important part. This is different from your sales and cost plan that we have been talking about. A cash flow plan is a forecast which shows you how much cash you expect to come into your business and how much cash you expect to go out of your business each month. Now, there are many reasons why your business may run out of cash. Number one, you buy goods or you buy raw materials. Number two, you give credit to your customers. So the amount of money you sold some goods, you have not yet gotten the money immediately. Those are the credit to your customers. It may be one of the reasons why your business may run out of cash. It does not mean that you are at a loss anyway, you need cash to buy equipment. So you also, these are various reasons why you may run out of cash at a particular point in your business. These are what would include in the cash flow. So let's move on. Very good. A very important part of your business. Please look at this very well. I will not overemphasize this. Your sales and cost plan. We've looked at that. Now, this is another part of your business that is very, very critical. Very, very critical. And we are forecasted for 6 months. The cash flow. This is like it's more than your report card. This is like a lifeline for your business. I call it a lifeline because if this is not there, investors will not even attempt to think about your business. This is a lifeline for your business, and it also tells us everything about your business. Now, look at the first column there. It says cash at the start of the month. Cash at the start of the month. This tells us how much actually came in. It is very much encompassing than the sales and costs plan that you made. This one includes so many things. Now, the cash at the start of your business or the start of the month now tells you the money that you invested or people invested. Remember that in the test training, we were told that equity is all the money that people invested into your business. Your business is you, and you are your business. However, you are your own entity, and your business is its own entity. If you invest into your business, that is an entity different from you. You pay yourself in the business, so you are a different person. You invested in your business, that's a different person. You are 2 persons in one now. Okay, now other investors are also investment. Your equity includes your own capital that you invested and the capital people also invested in your business. Now, from the table you are seeing there, cash at the start of the month, January, 33,500. That may be 33,500 million. It may be 33,500 billion. Anything that anything you assume, okay? Or 33 billion 500,000 rather, 33 billion 500,000, 33 million 500,000. Sorry about that. That was a mistake in error in mentioning the figures. So it may be any amount there. Now, the next row there shows cash in from sales. Cash in from sales. That is the next row. And you can see that in January, we had 1,500 cash in from sales. Cash in from sales, 4,500 the next month. If you look at the money that was reinvested into the business, we had just 10,900. So the money you reinvest into your business may reduce because the business will start running itself at a time. And that's what your cash flow plan will show. People invested in business, the original amount you invested is shown in the first month. Other money you put in as the business goes will reduce. The business will start running itself because you are now making profits. All right. So another cash in is zero there. So you see zero recorded as another cash in. So you don't have any other cash in. At that point, when you say another cash in, maybe other people investing in the business. So apart from cash in from sales, did any other cash come in? Did any other person, did you get cash from any other source after cash came in from sales? Okay, during the period of the month, that will go to another cash in, and you specify where the money came from. Okay, in that place. So if it is cash that came into your bank, you state it there, cash in bank. If it's that cash that came into your hand, you state it there, cash in hand that came in hand. So, and you put it there under cash, any other cash. That's the column for that. Okay. But first, the first one that comes in that line there is cash in from sales. Very, very important. Then total cash in. You can see it there. Total cash in, 35,000. You are through with that. Now we go to cash out. Now cash out is the next column you prepare. Cash out, and that DMC means direct material cost. So you have direct material cost there, DMC. Then you have hello. Please, can you hear me?
Yes.
Yes, we can.
I lost connection. This can really be very frustrating sometimes. Very frustrating.
Yeah, I can hear you.
All right, thank you. I'm trying to share my screen once again, and we can continue from there. Okay. All right, I believe you can all see my screen right now. Can you all see my screen? All right. All right, so we are back on. Can you see my screen, please?
Yes.
All right. All right, please. All right, let's quickly run up. Let's run up. So you have your direct labor cost just after your direct material cost. These are cash out. So you prepare your cash out. The money that goes out, and direct material cost. If you are in production, if you are in agro, your direct material cost includes all the money invested in getting livestock, okay, getting the feeds for your livestock. If you are in direct material cost, if you are in production of clothing, you are in cloth line, your materials that you bought, the fabrics you buy, the machine, all those things are involved in your direct material cost for your production. Then you have direct labor costs. Your direct labor costs do involve people in production of your products. They go into the direct labor costs. You put them there, put those things there. Now, cash out for indirect costs, okay? Cash out for indirect costs. And that cash out for indirect costs is all the costs you incur rather, which we have explained before, for running your business indirectly involved in the production. So like your NEPA bill, tax. So if you pay tax too, it goes into that place there. So your tax goes there, your cost of power supply, your cost of running the power plant, and all those goes into your indirect costs. Okay, transportation, please don't forget, transportation of your goods and services are very, very important, and you must indicate them, and they are under indirect costs. Do not forget that. Now, when you go to your permanent equipment, that's out permanent equipment, you see that there's only one-time payment for that permanent equipment, and it is not repeated again. You pay once, and that is maybe you acquired a building, just where you run your business. You acquire the structure for that. I can see that it's indicated there 13,500. Okay, you don't pay that again, because it is only once. Such things are paid once. So your place of where you run your business actually. So you can see that there is no other payment for that in February, March, April, May, June. All right. So maybe after 1 year, if you renew that, you have to put that there again. But for now, you have only one-time payment for that. Any other cash out, maybe any other expense that was made. So, and you may want to indicate the other expense you made. It may be any other indirect costs you made during the course of the business, maybe you paid for some services that are not directly related to your business and also. So all those things goes into your any other cash out, and you will want to specify. So where did the money go to? Did you pay for tasks? Did you pay extra money for extra labor? Did you incur extra cost? Please put that in under any other cash out. This arrangement is critical. Do not place one above the other. This arrangement is the standard arrangement. All right. Then your total cash out is 24,100. Now subtract 24,100 from 35,000 naira and you get 10,900. And 10,900 is carried forward to where? To February. And so when you see February, you see 10,900 in February. So this shows that the money that you have in February, in March, in April, in May, and June are the money you carried forward from each of the previous months. All right, so because of our time, I will not want to, you can ask any other question on the TEF platform and I'll answer you. But I want to move on from here because you can see from the screen there that you would carry out your 10,900 is carried to February. When you look at February, you see 10,900 upward, you reinvested your money back in, okay, and use it to continue running your business. You can see that 6,400 went in. The cash sales was 4,400, and you can see that at the end of the business was reflected. That's for February. The same thing for March. At the end of June, this person was making a profit at the end of the month of 7,400. A very nice return, by the way. Very nice return. And this is what your cash flow should indicate. You can see that it is totally different from your cash, from your cost and sales plan. Totally different from your cost and sales plan. Because here, it includes the total money that was invested into your business from January. And then it goes on like that from January to June. All right, I'll move on. And you can see that it is different from, this is for sales, while the previous one was for production. This one now is for sales. And you can see that there's a difference. Look at your cash out for the direct labor cost. Look at the line there. Let me see whether there's a highlighter. Let me see whether I can get a highlighter. I can see that, okay, I have a highlighter now. So I would highlight this area here. You can see it there, this area. All right, so that is, you can see that this area here, you can see that there's nothing here for labor, nothing here for labor. It is quite empty. That is because if you are dealing with sales, you don't have to include that. You don't include that. All right, so let's move on. And this would be, I think this would be the last part of our slide. I want to appreciate every one of you for taking your time to be part of this. I want you to look at some calculations now. What we call variance analysis. So having prepared the sales and cost plan and the cash flow plan, it becomes necessary to compare the actual performance of the business with the plan. This is usually done through a variance report, which reviews how the business has performed related to the plans on the various sides. And this will take place after you started running your business properly, okay? Not during, this analysis does not take place before you start running your business properly. So you will then need to investigate how you are doing. And this will help you to go back to your drawing board. Are you doing well? Are you doing according to your assumption? If you are not, then you want to, correct something. So record keeping. Now, this is another aspect that you would want to take very seriously. Record keeping. We have two types of record keeping. We have the single and double. Okay, single record keeping book and double column record keeping book. Let us quickly look at record keeping. Record shows how helps you to control your cash, and you want to include that in your business plan. So how do you intend to keep your record? And you want to show it actually. Okay. So we have how to select a record. For type of record, it's based on the size of your business. If you are running a very small business, then you are using single. If you're running a bit larger business, you are using double. So let's quickly go there. I don't want to waste time on that. I want to show you how to keep it. Let me show you the okay, this place is important. It says in the circumstance, it is advisable, okay? It is advisable to choose a record-keeping system that, 1, will provide the information you need. 2, is not more detailed and complicated than you need. And 3, you fully understand even if someone else is keeping the record. So your record, your bookkeeping, it's also called bookkeeping. Record keeping is also called bookkeeping, and it is very simple as possible, as simple as possible. And okay, single entry. Let us go to single entry. This is a single entry. It shows your sales, shows your cost, shows brought forward. So you have your dates, you have details, and you have sales and cost. So in your detail, you have brought forward. In your sales, you have 380. And this 380 was brought forward from the previous month, from your sales of last month. That's what you brought in. That 380 came from last month. Your sales for the present month goes for 300. You are in this, you are still in the same month. So you just started the month. The first day in the month, you brought in 380. The fourth day, you made a sales of 300. You bought timber, that goes to cost. So you can see that this goes to cost now. And this is prepared to show each month's expenses, but does not show any other expense apart from cost and sales. Cost and sales, money incurred and sales. It's as simple as it should be. Now let us go to double. Let's go to double. Look at your double entry now. Your double entry bookkeeping or record book has more details. It has more details. Here you have cash at hand and cash in bank. Then you have your sales, you have direct material cost, direct labor cost, indirect costs. Okay, I will share this material with us later, especially this area. I will share it with us. If you need, please indicate, just send me a DM or on the platform. Let me know. I want to round up this session, and this part is also important. You want to show this too in your business plan. This is just showing your record keeping. It's your bookkeeping. How do you keep your record? You want to show this, okay? Your sales, your direct material cost, direct labor cost, and it is different from cash, sales, cash, and costs, or sales and cost plan, sorry. If you have any question, please, I'll take your question later. Now, look at this. There's cash in and cash out. Cash that goes into the bank and cash that goes out of the bank. Okay, and what you were used for. So the details are there. Your invoice number is there. Your other details are there. So quite simple. If you think that there's any complication, let me know later. I want to thank you all for listening and for being wonderful participants. Thank you very much. And this is, at this point, I would want to close this meeting. Thank you for listening. All right, thank you.
Thanks so much, sir. Thank you so much.
Really appreciate your time.
Thank you very much. Thank you. Is there any question? You have questions? I think I have just some minutes to go to ask question, about 2-3 minutes, because the meeting would end in some minutes. To end itself in some minutes. All right, so I'll entertain questions now, please. Okay, in the absence of no question, I would hence end the meeting. Meet you all on the Telegram platform, guys. Have a nice night. Have a nice night. Have a nice night. Thank you very much. Thank you. Thank you. Thank you.